Good. Welcome, everyone. This is the Global XTL Summit series, Enablers and Barriers to Project Financing. I would like to, just welcome everyone, attending. And, we're looking forward to quite a useful and informational session today. Want to invite, Dave Livingstone, MD for the group of Citigroup, of companies, as well as Paul Brown from Insurance Risk Partners. Gentle welcome, and let's have a wonderful discussion on enablers and barriers to project financing. My name is Nico Deersma. I'm gonna just run you through the setup on disclaimer. This is information that you should actually vet yourself as well, and the information is there to assist and guide us moving forward. The objective of the Global XTL Summit is really to enable, to create, the platform and, define a voice, but for us in the industry to take ownership, leadership and stewardship of what we've received. This will create a platform for a variety of different stakeholders in this blooming industry to come together, work together, and make this successful. That's really part of the mission, vision, and objectives of what we would like to achieve here. We've got a number of upcoming events. The next one with Dr. Stefan Onash on the different compliance, LCFS credits, runs, the fuel standard, and how that will, influence the way we look at, the different projects, but also then a variety of other sessions that we would inform you about. But without further ado, let's start off. I am going to start, and hand over to Dave, so that yourself can start with, what you want to share with us today.
Great. Thanks, Nico. As Nico said, I'm Dave Livingstone, and I'm a banker at Citigroup. Have been financing waste-to-value projects for more than 30 years, primarily in the U.S. and primarily on a project finance basis. Project financings, needless to say, are pretty complex, and it's sort of like the old saying, like almost only works in horseshoes and hand grenades. And project financings, you need everything to get done to get to a successful closing. If one or two of these elements in this little diagram don't happen, you end up with a failed transaction, not being able to get a project financed and built. So these are quite complicated, and what Paul and I want to talk about today is a little bit what are the things that have come up recently which have made these projects more difficult to finance, and what we've been able to do in the financial markets and in the insurance markets to try to overcome some of these hurdles that we've encountered in the projects. On the next page, as I said, I've been doing this for a long time. So, 30 years ago, things were a lot easier. We financed a lot of projects, like almond shell to energy, or orchard prunings to energy in California. And, those were like proven technologies, stoker boilers or fluidized bed boilers producing electricity and steam generators, technology that had been around for decades. Construction, you had a lot of construction contractors who were willing to provide, lump sum, turnkey, sort of fixed price and schedule contracts with a full range of performance guarantees. On the feedstock side, you could, contract with a couple of landfills to deliver urban wood waste, or, a set of farmers to deliver orchard prunings. And then on the output, this is when utilities were utilities and had, controlled generation, transmission, and distribution. And, in California, this great thing, standard offer 4 contracts, where, utilities bought the stuff under fixed pricing, um, and as a result, from a financing standpoint, all the major things you check the box: creditworthy, good technology, creditworthy contractor, creditworthy off-taker who's taken the electricity at a fixed price. Unfortunately, things have evolved, and not necessarily to make it more easy to finance the projects we're seeing today. Organic waste to jet fuel, or dairy manure, anaerobic digestion to synthetic renewable natural gas. So some of the hurdles we're encountering today are shown on the next page, and sticking to the same technology, construction, feedstock, and output. From a technology, maybe the technology's proven, but maybe it's been done with a different feedstock. We've financed a project a couple of years ago that used proven technology, but in sort of forest residuals, not rice straw. And then we see a lot of emerging technologies which have only been proven sort of on a demonstration plant basis or in a single commercial facility. A lot different than those projects we were doing 30 years ago, when you could point to dozens of projects almost identical to what we were building. On the construction side, you guys are all probably familiar that turnkey contracts are available, but they become extremely expensive, and far fewer contractors are offering them. We additionally have found sort of unwillingness to provide sort of full system, what we used to call shoot to stack performance guarantees for these somewhat emerging technologies. And then on the feedstock side, for the AD projects, many farms are small and not necessarily creditworthy. The projects obviously can't easily be moved. Waste products are not commodities and cannot be hedged. So, feedstock has become a little bit more difficult. But maybe more difficult than feedstock are the output. Clearly, if we're talking about like RNG or waste to fuel, liquid fuels projects, we all know the prices for natural gas, diesel and jet fuel. Those commodity prices are incredibly low. They don't support building a project. The thing that have made these projects viable recently are, RINs and LCFS. Those projects are great, but LCFS isn't like Southern California Edison agreeing to buy the power for 20 years. The LCFS program, it's relatively new. It's held up well in the pandemic, but it does expire in 2030. And to the extent you can get fixed price contracts for the output, they're at a very large discount to the market. So what do we do about these hurdles? From a technology standpoint, we've seen the emergence of performance insurance, and Paul is one of the experts on that. He's going to spend a little time talking about that, but we've seen the insurance companies, Munich Re and New Energy Risk, are the two most active in the market to wrap the technology performance risk. I don't know, Paul, do you want to speak now or save it for a page or two later?
No, let's touch on it now, Dave. Thanks very much. And Nico, thanks for having me. From the insurance side, in the good old days when projects were easy, as Dave said, you would call your insurance guy at the 11th hour. Hey, we've got a project. It's going to financial close next week. Everything's lined up. Somebody call the insurance guy. We need insurance. With the emergence of many of these risks, the insurance dialogue and the risk design has moved to the front of the equation versus the back. If anybody's leaving it to the 11th hour, they're likely to be in trouble overall. And one of the areas where this has been especially critical is in the emergence of technology. Insurers don't like to be the funding mechanism for prototypical technology. It's happened in the thermal industry with combustion turbines, and it was a very painful experience for them. So a few of these insurers, such as New Energy Risk, Munich Re, Energii, et cetera, have tried to create more collaborative relationship with the projects and with the OEMs, where they are looking at the first commercialization of a project to bring the technology insurance to play. And what it's focused on is giving financial support to the project by addressing some of the debt needs and security of the lenders, A-rated counterparty, debt buy down or resizing if the technology doesn't work, but also being an integral part of the project by vetting the technology, being close to the OEMs and the technology guarantees. So it's creating a collaborative process versus just tossing the technology risk in the insurer's lap. It doesn't make it cheap, but it makes it affordable. And that's what's important, because it looks at helping a project or a technology come into commercialization so that this segment can grow. And it does so by buying down the debt or resizing it, or addressing cost overruns. And we'll touch on that a little bit later in more detail in our presentation.
Great. Thanks, Paul. Again, from a technology standpoint, and this actually goes for all of these hurdles, one of the things we've done is, used to be deals got financed almost exclusively with investment grade ratings, or investment grade credit quality. And, the rating agencies, Moody's, Standard & Poor's, and Fitch, are like being in elementary school. You take your project to them and they grade it. And investment grade is a standard that, is a high, probability of a very high probability of repayment. But we've been able to more recently find investors willing to take non-investment grade project finance risk. And, again, when you have technology, that's not, can't point to a dozen plants just like the one you're building, or offtake where maybe you've got a contract for 5 years and you're taking some market risk after 5 years. Those are the sorts of things that make for non-investment grade credit. And, we've been able to structure deals and find investors on a non-investment grade basis, which is sort of, from the financial markets, one of the ways we've gotten some of these projects done. On a construction side, again, the performance insurance, does help to, if you have multiple equipment suppliers, to sort of wrap the overall package. I don't know, Paul, do you want to jump in here?
No, that's right. That's part of both the technology and or the construction side of what the insurers are trying to bring to the equation, is kind of gather up the liquidated damages, gather up the performance guarantees, and get them into a bucket that the financing parties and the equity parties can rely on. It's almost an assignment structure where the insurers will wrap around it, guarantee that those are paid, but you've got a single point of focus. And again, it's in that collaborative nature of trying to understand the technology and provide a solution to the construction side, which many of them understand, but lend a little bit of the insurer's balance sheet to the equation as well. Again, at a cost, but for the purpose of moving the technology and moving projects forward.
And some of the other stuff we've done is, larger construction contingencies. That's a little bit of a brute force method. But, the other thing is, there's been a greater focus on integration between the construction contractor and the equipment supplier, and, providing an actual integration agreement, which talks about whose responsibility, so that, hopefully you have a less of risk of running into disputes between, the civil contractor and your equipment suppliers. And then I guess the other thing we've, been requiring is a far more comprehensive role for the owner's construction monitor. Really try to make sure they're on site, throughout the construction period, on really a daily basis, to make sure that, they can nip in the bud potential problems between the contractors and the equipment suppliers.
Dave, if I can, add to just one comment here, I think the importance of the owner developer to make sure that they've got an intentional strategy of how they deal with the different types of risks, transparency about who is responsible for that, and how do you allocate and how do you mitigate, in a very clear and concise way, is absolutely important to make sure that you've got a proper definition.
That's absolutely right, Nico. I mean, projects we were financing, 3 years ago, this was hardly discussed. And today, projects we're financing today are, this is a, key area of discussion. And there's a lot of, lawyers and contracts dealing with that, which you just didn't see, as I said, a few years ago. I guess, moving on to these hurdles again, feedstock, now getting to the operating phase, multiple providers, to reduce reliance on a single party. Again, if you're contracted with waste management to deliver urban wood waste or organic waste, you don't need to have multiple parties because they're a strong, investment grade rated credit. But if you're talking about, what we've seen is like in the dairy waste AD project, trying to get several dairies close by, and you have to say pipe the put digesters to 3 sites, pipe the gas to a central gas cleaning site, which again reduces the risk that one of those dairies goes out of business, and it impacts the project. Paul, you want to talk about some of these other
Sure.
other points? Yeah.
The feedstock piece, as it does, as many of these projects start to get kind of into, rather than an integrated supplier of feedstock, it's de-integrated and there's multiple participants. The insurance world also looks very heavily on what do the contingent supplier risks look like. If there were a loss and suppliers couldn't provide product from a centralized location, what does the backup look like? Because they're thinking about the business interruption. What's the downtime? The same as the lenders are looking at it. And in this case, the insurers kind of look through it through the financing eye of how do we keep the business running? How do we keep meeting the debt service, the fixed costs, et cetera? And in the past, the insurance community had a broad solution. It's become very narrow in the recent years. And so it's very important to identify who those contingent suppliers are and understand how they can be mitigated, where we're going to have additional sources of supply, and have the plans in place early on so that the insurers can kind of fit into this. And much of it is really thinking as much as managing the risk of loss of feedstock. It's no longer, hey, I want to make it simple and I need it to show up at my doorstep. Because of the nature of the insurance move, it's occasionally necessary for the project to actually take risk of loss of the feedstock much earlier in the supply chain. That way they can integrate the movement of the feedstock, the storage of it, the aggregation of it. They can move that into an insurance package they can control, more for making sure that if something happens, there's a mechanism to trigger their financial support insurance to continue to make debt service and fixed payments to keep the project moving along. So it's a little bit of a different mindset that comes to it. And again, it's about identifying the risks, as Nico said a minute ago, much earlier in the process, and really making sure we understand who has the risk when and how it can be addressed or mitigated either through insurance or through other counterparties. And these additional suppliers, et cetera, and we've seen this a lot in other segments of the renewable business, you really have to think about where they're located. Could they be impacted by floods or windstorm or earthquake, wildfire, other natural disaster? And where does the risk and expense of keeping the business running compared to force majeure provisions or other aspects kind of sit within the supply chain for feedstock. And while it's, again, in the past, you've got kind of one big provider of input, you've got a lot of different resources out there now to provide product, and we're looking for the lowest typical cost of it, whether it's transportation or the overall cost of the feedstock, but really understanding structurally what happens if it's interrupted and how does the business continuity plan work. Again, early in the process to understand where insurance may or may not provide some support as the insurance market changes.
Thanks. And I guess moving to the last element, output, which is, probably on most projects the most important, because that's, where your revenues are coming from. The bulk of your revenues is output. We've seen, again, rather than a single contract with utility, sort of multiple contracts with a variety of different tenors. We've seen, contracts, where you have, fixed pricing for a period of time. When I say fixed pricing, both the environmental attributes and the commodity for a period of time, and then market pricing, and maybe you layer on some requirement to build up reserves if those fixed pricing, those contracts don't get renewed, during some of the market pricing period. And then the other thing, obviously, a more robust project financing with more equity. We saw a lot of projects done with 20% equity, back 20 or 30 years ago. We see 30 or 40% equity, because we're looking. There's a lot more project risk, and bondholders or debt holders, they don't see any, they don't benefit from the upside. They only get hurt by the downside. So, we've seen more equity and more robust project economics. But I know some of the things that, we've seen that are, I think, most interesting on the output side are some of these insurance products, which Paul's going to talk about, which, this is a little bit bleeding edge technology, but, I do think having, work with Paul on these products for a project, they're incredibly interesting, and maybe can take the place of some of these fixed price contracts. Paul?
Yeah, the world of credit insurance is starting to really play a role for this segment, and part of it is just dealing with a credit-worthy off-taker. We've got to bring a certain level of credit to the table, and many insurers have worked in the world of trade credit in the past, dealing with receivables, and there's been a group of them trying to move into kind of the world of upgrading credit quality of the off-taker, and it's a combination of reserving, credit management, and insurers understanding segments and willing to take risk, because insurers by nature take calculated risk. Their formula is a pretty simple one. It's probability of loss times severity plus profit and cost. And banks and finance groups have a different risk tolerance from that. So we can run this concept through the insurance machine, turn the crank, and frequently out can come a product that says, in the event the off-taker doesn't pay, can't pay, won't pay, assign your rights to us and we'll pay on their behalf. And then you end up with an A+ rated off-taker guarantee by virtue of this insurance product. So it's lending a lot of value to other segments of the industry, and especially because many of the insurance companies are looking for an environmental path to deliver products, where they've gotten out of some coal projects, for example, in the past, mining, other things that are less environmentally friendly. They're looking for places to deploy capital, and there's not that many opportunities to generate solid returns while at the same time doing good in the world. So they're really looking at many of these from an ESG standpoint. They're bringing a renewable concept to them, and they're bringing a valuable solution to the table. So the credit products and some of the business interruption concepts are very interesting as they're developing really over the past 12 and 18 months. and we'll see them continue to develop over the course of the next few years as more and more participants come into this side of it because they see that there's a reasonable return and they're supporting something that's a viable industry that's really early in its growth pattern. Nico, I think we've got some of these kind of risks in insurance in the coming pages as well.
Paul, if you mind to make a comment on, the traditional was hedging, was a mechanism to be used, and insurance, as you said, developed in the last 12 to 18 months quite substantially. The pricing differential between just normal hedging and insurance products?
Yeah, so insurers, especially if you can add something to the equation. So insurers, if you add one extra item, whether it's say a credit product with a weather contingency, or you add a credit structure that if this happens and this happens, then we kick in. Insurers are very good at adding kind of multiple triggers to things, and every trigger that we add becomes a lower cost mechanism. And then part of the balance is in many traditional hedges, it's kind of on or off, it's win or lose, and it's a price. In the insurance world, being risk takers that they are, often these products have kind of steps to them. And so if you get over one hurdle, the default, but there's still sufficient revenue to the project from other sources or from reserve accounts, and then you got to get to one more trigger. As you kind of layer on the triggers, you start to bring the economic costs of these products down, and the duration of many of them are getting out there. So, for example, the technology insurance now is heading towards 15 years of coverage, where just a few years ago it was at 7. We're seeing some of the political risk type insurances go from non-existent to 5 and 7 and 10 years. And these credit products can go out for a dozen years as well. So you're seeing this market really move. And by virtue of structuring and having kind of multiple triggers, you're also starting to see some costs that, again, they aren't cheap, but they become affordable, especially given the economics of some of these projects.
Is Nico moving on? I think these are some of Paul's pages.
Good. So we'll move to the next
slide, maybe.
There we go.
There we go. So we've touched on these some, and I'll move through them. Nico, tell me if we're getting too long-winded here, but some of the key ones when we think about, again, kind of sticking the same, the technology, we've talked about this a little bit, but technology providers, many years ago, there was systems performance insurance and efficacy insurance, and it was really used as a funding mechanism by OEMs to be their kind of their proving ground. Their warranties got more narrow, and they said, we'll just rely on insurance. And the insurance communities paid millions and millions of dollars of claims, and the relationship got out of whack. New Energy Risk and a few others really came in, Munich Re and to some extent Energi came in and said, we're willing to do this and lend our balance sheets to bring technology forward, but it needs to be more collaborative. You've got to bring us into the laboratory and you've got to bring us into the testing grounds, but then we can really lend our balance sheet to guarantee the technology. And what they've come up with is if a project just simply or technology simply doesn't work, their products can buy down or completely pay off the debt. They've committed enough capital out there, more than 250 million can be put together to essentially say, if this technology doesn't work, dear lender, we will basically buy out your position and we'll figure it out. And that's created a lot of value, but initially that was just a single point in time, mechanical completion or substantial completion. They then went on to say, it may work initially, but then due to technological problems, the operating costs go way up, or the conversion rate drops and it takes more feedstock to create the same output. And they've said, while figuring out this technology issue, we will make sure that the debt service reserve stays at, or the debt service obligation stays kind of right at a 1.0 relationship, so the project stays in business. And it's really pretty interesting because it layers in with the guarantees from a contractor, layers in with the guarantees from the technology provider, but it wraps around to provide hundreds of millions of dollars of collateral protection for lenders, making sure that a project can stay alive and survive the bumpiness of technology. It's not warranted in all of it. It's meant for the first few units that are going into commercialization, but it has had a very valuable benefit in plastics recycling and jet fuel manufacturing. And so we've seen it successfully used in financings already. What makes it affordable is the way that they essentially turn themselves into a piece of sub-debt if the product's used. And that gives them a chance to optimize the project and get some of their money back. So again, it's not cheap. It may cost 8 or 10% of the amount of insurance you need for 10 or 12 years as a single payment, but it does make projects that otherwise couldn't get financing financeable. In that same world, sorry, Dave.
Yeah, I was saying that's the important thing. I mean, we all say this stuff's expensive, but if that's the difference between getting a project financed or not, it ends up being, cost efficient.
Yep. We've seen it, move the leverage point to your point earlier. Leveraging was kind of 80 debt, 20 equity in the past. We've seen 50-50, 60-40. It can unlock the leveraging mechanism again and get you back to an 80-20 because you've got an A-rated carrier saying, we'll make sure the debt gets paid. Or you may have sufficient leveraging, but it attracts a lower cost of capital. So from a developer standpoint and for those providing a financing solution, it can do multiple things. And it really is kind of weighing, if I pay $10 million for this product, what value am I unlocking? And the insurers can't, they can't take all the value for themselves. And so there is commercial pressure for them not to get things out of whack. And where there used to be one insurer, there's now 3. There will soon be 5. Terms will be longer, up to 20 years. We've seen that in the solar space, for example. We're already seeing 15 years in battery technology. And so as the competition comes in, the pricing will come down and the terms will get better. So these are some good products that are just getting better. One of the difficult areas, and Dave, you mentioned that many of these projects, because of the underlying price of just the pure commodity, jet fuel, renewable diesel, diesel, et cetera, the commodity price is just so low, much of the value of a project are in the incentives. And this is an area that insurers are starting to really understand. Just like they've provided business interruption insurance in the past to support revenue in the event of a physical loss, they're starting to move in this direction relative to supporting commodity pricing or incentive pricing. And they do it in a number of different ways. They're seeing that these fixed price contracts, they're very expensive to equity, meaning the off-taker that gives the fixed price contract takes a majority of the value out of the equation. The insurers have come in and they've seen that value and they understand the industry. They're just being less greedy. It's not necessarily that they're finding a solution. They just are saying, we're a solvent counterparty. We've got needs internally for supporting environmentally solid projects. We don't have to be as greedy with our return because we just need 8 or 10 or 12 for our capital balance sheet and building our capital books. We'll just be less greedy and we'll provide a contract for differences. We'll do a long-term deal with you at $100 LCFS instead of 30 or 120. So you're seeing insurers kind of move into an arena, and we saw this a few years ago with the likes of life insurance companies and global property and casualty carriers coming into the tax equity sector of the renewables of wind and solar. And so you're seeing insurers move into this space too, to fill not only a need for your normal insurance, but also some solutions relative to the revenue streams. Synthetic offtake agreements, much like we see kind of proxy revenue swaps. And many insurers have a capital markets department. And they're seeing this as, we are looking for good investments with a good return. We understand regulatory risk. We are regulatory animals. We want to get in the game. And so it's kind of a new world for some of these insurers. When they start to solve the problem and everybody becomes less greedy, they will exit this. But in the interim, they're providing an interesting solution. There's also a new exchange being launched in London in January, and it's meant to match capital providers with people that want to sell risk, which is really what insurance is. I want to sell the risk of my car being damaged in exchange for this much premium, and somebody wants to buy the risk in exchange for a certain price. And so this exchange is meant to really, these are my risks, reduction in LCFS pricing, or change in regulatory approval. And then in London, access through the global markets to basically match up people that are willing to take risk. And you're going to get this open exchange of, I've got this risk and I want this, I'm willing to take it for this price. So it'll be interesting to see how these projects are attracted to some of this new exchange, where people that need wildfire risk in California are going to be playing, people that need hurricane risk or typhoon or product liability for pharmaceuticals, they're going to be in this exchange along with people that want incentive risk managed. So it's a really interesting and dynamic time in the insurance world for potential solutions for this segment. Maybe the next slide, Nico. Feedstock's a tough one. Insurers have tried to solve this one in the supply chain side of things. There's a world of stock throughput, supply chain management in the insurance world, and they're trying to deal with feedstock as well. Not so much in an aggregation, but how they can take certain segments and address if a production facility or an aggregation location is damaged, we can source at an extra cost feedstock from these other places, and we'll pay the incremental increase. If, for example, manure is being delivered via pipeline, but something happens to the pipeline, they can pay the incremental cost of trucking it in. And so there is this segment of, we have a path towards providing some security around the feedstock. And it may be a combination of creditworthiness and this extra expense of sourcing it from far-flung locations, depending on what it is. So there's a world in there where this is moving. It's a little bit more in the wood world, municipal solid waste, plastics recycling, things you can get your hands on. But insurers are trying to move into that world. We talked a little bit about the credit risk earlier, but again, using an insurer's balance sheet to upgrade the off-taker credit's an important piece of the insurance world. We can't take them from bankrupt to investment grade, but through a combination of reserve accounts, accounts payable management, and a reasonably solid off-taker, a couple of rungs below or multiple rungs below investment grade, insurers are willing to take some credit risk. And again, they step in, make sure the payments happen, but then they pick up the right to pursue things. And as they get more into this industry, they'll also understand where they can deal with and find alternative off-takers and address that risk. And probably one of the most interesting ones is this world of EPC wraps, which essentially, if we think about a wrap from my perspective, the insurers like them because they kind of have one neck to go after if something goes wrong, and the insurers pay a claim because of a default, et cetera. But a wrap's really borrowing the balance sheet of another company. And insurers have started to see what the cost of this is, sometimes 20 or 30% of a project, maybe even more to get a full wrap. And when we look at the dynamics of what a wrap provides, performance LDs, delay LDs, but still with a fairly small kind of 20% overall cap for those, the insurance community can get their mind around that and start to create a platform and there's a couple of firms out there that have partnered with insurers to do just this, is we'll wrap in these other bits. Mr. Insurer, you'll take the credit risk that the technology provider goes bankrupt and can't meet their guarantee. And you'll take the risk that this one won't pay, or you'll take the risk that this happens, and the contractor, will focus on putting the thing together properly. And so they're coming together in a partnership to wrap technology, upgrade performance and liquidated damage LDs, even deal with weather delays in a fashion that kind of packages up if you've got weather sensitivities, making sure that a project finishes on time. So it's pretty interesting where that world's going. It's been an interesting partnership over time. I've seen Allianz partner with Siemens, for example, on thermal generation projects. We've seen New Energy Risk and Koch in this segment. We're going to see some others over time come together, but it's worth knowing that the insurance world has some products to bring to the table in creating wraps or synthetic wraps.
I think, Dave, if you can maybe, talk about the tax-exempt market overview with, the time that we've got available.
Sure. As I said, I'm at Citigroup and been doing this for 30 years, and I've got a team of 8 people who, use this tax-exempt market for these sorts of projects. And, one of the things when we started, becoming involved with, anaerobic digestion or gasification, waste gasification projects and the like, is we found it unusual how few people were aware of this market. So I thought I'd just talk a little bit about it, how, why it's attractive and how it can be used for these sorts of projects. But you may know about the U.S. This is a U.S. only product, but it's primarily for state and local governments in the U.S. to finance their infrastructure. City of New York, state of California issue billions of these bonds every year to finance, roads, wastewater treatment plants, and the like. Corporate borrowers can access the market to a very limited extent, and one of the areas is what's called solid waste disposal. And by IRS rules, solid waste disposal is any sort of processing of residual or used materials. So you think about forest residuals, the bark and tops and limbs. We cut trees down for lumber or pulp, or the manure and anaerobic digestion. Municipal solid waste is an obvious one. But all of those things are considered solid waste, and they're eligible to be financed in this market. Moving on. Yeah, some of the projects, in the sort of waste to value area that have gotten financed, include, Fulcrum Sierra plant, the Red Rock Biofuels, which, I know is had some issues, but they just raised some additional debt, I guess yesterday or the day before, which should get this project back on track. A couple of AD projects in Arizona and California. Res Polyflow, which takes plastic waste and recovers and recycles it. And others. So, a number of the marquee projects in this waste to value area have gotten financed in this market. The next page. Why would we consider this market? Why should you consider this market? For one reason, it's a tax advantage market. So it offers lower interest rates than comparable traditional markets. This is getting a little stale, but at the end of 2018, we did some tax-exempt bonds next to a term loan B for a natural gas to methanol project finance transaction. It ended up, being over 2% lower interest rate for the tax-exempt bonds. But almost maybe more important than that is it does accept non-investment grade greenfield credits. It's willing to accept a certain level of technology risk and non-traditional construction arrangements. You're able to go out pretty long. 30-year debt amortization is something that's common in the market. So, we think that, it's proven itself to be a pretty good market to get these projects financed. Next page. I've talked about this earlier. Any used material, any recycling process that is eligible, and residual materials are eligible. This stuff will be available to you after, and you can pour through it and give me a call if you have questions about it. The last slide in this section. Again, some of the terms we thought are helpful. Again, you can go out 30 years even for non-investment grade credits. It doesn't allow delayed draws. It's typically a fixed rate bond. You pay the same interest rate on it throughout maturity. Till maturity, it doesn't float with the market. We're able to do deals down to, if you get ratings, down to CCC, strong CCC rated transactions, and it's a fairly deep market. Even down to a single B rating category, we can raise upwards of $750 million of debt. We tried to give you some indicative pricing for sort of single B or double B rated tax-exempt bonds, and for going out fairly long, anywhere between sort of 5 and 7% is sort of range of rates that we would expect to be able to achieve it in the market. In today's market, it was probably 4 to 6% pre-COVID, but that the market got rocked pretty bad in March. It improved in April and sort of reopened in full in May, although credit spreads still are a little bit wide right now. I guess that's my hopefully relatively short primer on the tax-exempt market.
Thank you, Dave. And maybe, gentlemen, what we can do is, why don't I, post a typical project, and then you guys can, rip it apart or, add, what you think, how we can do this. To put example, I've got, just as a poster child, I've got a bio to liquids project that I want to develop. I want to use wood chips. I've got a technology. It's not been commercial yet. Offtake. I've got people that would like to, look at the product, a trading company that would like to buy my product. And, I've got an engineering company that I know well and people that I know as friends, and, want to use them to do the construction. What are the type of things that, that you guys would ask me, and Paul, how can you help me? I mean, I want to move this forward. I think it's the best thing since sliced cheese, and this is absolutely the best project. Everyone should know about it, and everyone should be doing it. How do I take this forward? What do I need to consider?
One thing there that we see right away, Nico, out of the gate, is we get a lot of these types of projects. We can totally do it. Technology's new, but don't worry about it. It'll be great. Off-taker may or may not have any money in the bank, but they will by the time this happens. But one of the very first hurdles, and the first things that we get, an early question is, can you lend me a little money to get started? It's almost the developer capital sometimes. We see a lot of them, and they're like, I just got to raise $5 million. I've got a commitment for $1 billion if I can get the first $5 million. Or I got a commitment for $500 million if I can do this. And we see that as one of the big just get off the ground hurdles. It's not insurance related. It's nothing more than, I've got an idea with these great parts. I just need to prove a few more things. I need to engineer a little more. I need to acquire a permit, a site, or something, or just have the test project to just do a little bit more. But this is one that we see as kind of the biggest hurdle to the projects that we have out there, and where we've seen more and more supports coming from kind of strategic ventures with people, even some insurance companies recently that have, again, capital markets that are looking to support technologies. We've even seen some insurance agencies get into renewables and where we want a piece of the action for future tax value to offset something else. But these are one of the hurdles before we even get into the hard work, is how do we get off the ground with development capital? I wish there was an easy way, but it's one that we see just day one a problem.
Yeah, and it's can be tens of millions of dollars to go through an FEL feed project, free feed process for a large petrochemical project. So development capital is hugely important, and it's extremely difficult to find and expensive.
Let's say that you won the lottery, Nico.
Yeah.
You've got the cash.
Yeah.
Then let's think about the next part of it, because you really have, when we think back, we got to take a project that's difficult and make it easy, because I don't know, bankers have an easy life and they want to make it easy, right, Dave? Guys, just sit back, bring me a project with these things, got my feet up on the desk, time for a martini. It's not that way, but we have to think about it that way. And one of the first slides you put up has so many bubbles in it. I would encourage people to look at it, is that you really have to tackle it in a very logical fashion. But it's really just basic blocking and tackling that Dave led off with. You got to think about like the technology and how are we going to implement it. We got to think about the inputs to the project and how are we going to make sure they're there. And so they're just in a few buckets. But if you look at the part on the right, it can be a little bit overwhelming. But to get to a successful project, people should take away this slide and deconstruct this thing, and then talk to their advisor about rebuilding a process that tackles these right in a row. Thinking about the technology risk, the sources of the feedstock, the offtake, how the incentives come in, who's going to do my engineering, how do we put this thing together, how do we tie off the risks at the beginning and start really addressing them from day one? Because that way we're not trying to put a Band-Aid on them later by just throwing money at it. And we see a lot of that, and I'm sure Dave has, is they've gone way down the path, and then it's a technology problem. And they go, no big deal, let's just add 10 million for insurance. And then, well, your off-taker's got a problem. No problem, add 5 million for a reserve account. If you walk it back to the beginning and think about this slide, this is where you solve most of your project problems, but it's not fast. And a lot of people kind of want good, fast, or cheap, pick two, and they want good and fast, but it's not cheap. And so you got to kind of work through this process. And this diagram, I think, is really, as complex as it is, it's really a very simple, one step at a time, across multiple pieces of it, just logically moving the ball forward to avoid a lot of delay later and a lot of unnecessary costs later. I don't know, Dave, what you think, but when I see it, that's where I see the success come from a project.
Right. And I would say a couple of other things more in the weeds on the project, Nico sort of laid out. One, technology. There's sort of a step process of, a pilot facility, which, may, fit into a room or a couple of trailers. And then you have a demonstration plant, which, maybe it's not quite full scale, but it's, something where there's only, 2 to 5 times scale up to get to full scale operation. And, you go through those processes, and you make sure that you have, an independent engineer or something like that monitor this and be able to come in and say, yeah, gee whiz, I saw the pilot operation. I witnessed the demonstration facility, and hey, it it actually does work and works reliably, and the scale up of doubling the size or something like that, isn't you're not going into technology that hasn't been used before. So I mean, on that, I think that there is a process to make lenders comfortable with technology risk. The other two things are input and feedstock and output. And the input, a lot of these projects, either the cost of the input or the revenues you get from the input are relatively small, and there's a lot of this stuff. You're building, this project, in the southeast where there are a lot of trees, and if one plantation they close it down and use it for something else, there's a dozen others that have the material, and so that by having market studies both on the input and the output, again, those are the sorts of things that they can make investors comfortable with sort of maybe less stellar credits on for an input, a feedstock or the output. So you have a relatively small company providing the feedstock. Maybe they're not super credit worthy, but they've been in business for a while. That's fine if you have a consultant come in and say, hey, if these guys aren't there, there's plenty of other material that can be secured in this sort of wood basket.
Yes, Dave, thank you very much. Gentlemen, Paul and Dave, we've got 4 minutes left, and maybe what I will do is summarize, some of the takeaways that I've got from our discussion today. I think what I'm hearing is, there is a dynamic change in the world that we actually developing projects, and that could be whether it's in the feedstock side. There is a demand for the clean products. There's intentionality by the banks and the financing institutions to get into this market. Money is available, but there's changes in the way the EPC contractors are viewing the turnkey lump sum. And in all of this, with these dynamic changes, we see a response by insurance companies and other entities that are coming to the table and say, I want to solve the problem. I want to move forward. I need the right projects, to be able to step up to actually do this. But that means that the developer should have a very intentional strategy, a structure, systematically go through all of the types of risks and make sure that I mitigate the risks in whether it is with the right supplier, with the right type of off-taker, with the right type of insurance products, but that I've got an intentional structure and strategy of how do I deal with risk. In the end, we need to mitigate the risk to the level that is acceptable to actually get your financing done. But that means that the complexity is increased, and I can't just look at it from my point of view, whether it's a technology provider or just a feedstock provider. I need to have a holistic, integrated approach that addresses it from all the different perspectives. And it is more complex, but that's what is required today to be able to do this. Could I maybe, just, say, gentlemen, thank you very much, Paul, for absolute all your insight and development. I would urge people to connect with you or with us as required, and we can assist in that. David, thank you very much. I think, between the two of you, you've really demonstrated on the one side, what are the requirements, what are some of the opportunities, what are some of the ways of moving this forward. And it's been incredible, to hear your expertise in doing so. So thank you very much. Paul, maybe some comments from you, final comments?
No, thank you very much. The early focus on risk, you're absolutely right on. Move that dialogue to the front of the equation, and there'll be a tremendous amount of success later. And thank you for having me be a part of this with you and Dave.
Thanks, Paul. Dave, same from your side?
Yeah, I mean, all I'll say is, we were supposed to be sitting in a room in Calgary going through this as opposed to virtually. Let's hope next year we're all in Calgary again and meeting face to face. I'd love to meet everybody. Thanks very much for listening in on this.
So participants, people, thank you for registering. This has been, quite insightful, very good. Keep looking for the post. The next session is about LCFS credits with Dr. Stephen Onash from Lifecycle Associates. They will go to a lot more detail, essence in that. So thank you very much, gentlemen.
Thank you.
Bye.